Chapter 10 is all about liabilities, and this sheet shows an overview of the different topics that we're going to be covering. You should also take a look at the document at our e-learning site that talks about the topics we're going to be omitting, because there will be some topics related to the bonds and also 3 appendices at the end of the chapter that we're not going to be covering at all. And you don't want to spend a lot of time trying to figure out material that you're not going to be responsible for. So make sure you look at that document too. But this is what we will be covering. And notice that we're going to be dealing with current liabilities and long-term liabilities, as well as some other liability-related issues. So what's the difference between current liabilities and long-term liabilities? Basically, current liabilities represent short-term obligations that will be paid off or otherwise satisfied within about 1 year. Long-term liabilities are due to be paid off beyond a year from now. So the first topic that we're going to start with is notes payable. And this could actually be classified on a company's balance sheet as either a current liability or a long-term liability. Current if it's going to be paid off in a year or less, and long-term if you've got a note that won't be paid back for more than a year. Now basically you're going to need to know how to make journal entries for notes payable. And we studied notes receivable back in Chapter 8. Notes payable are really quite similar, but you're just looking at things from the opposite party's point of view. So I've got a sample problem, and this is the solution. Both the problem and solution are also posted under the content tab for you. And what I decided to do here is create just a short problem, and we're going to be looking at both the borrower and the lender's books. So we're talking about a situation where somebody borrows $6,000 from the bank for 3 months. The 3 months is going to span over the end of the company's accounting year, with the note not being due until March 1st. So back in Chapter 8, you would have looked at this sort of entry from the lender's point of view, the person that loaned out the money and now has a receivable to collect it back later. Chapter 10, we're looking at it from the borrower's point of view, and it's kind of interesting to see the 2 parties' entries side by side. So back from Chapter 8, if you were the bank loaning out the money, you'd be crediting cash, and the borrower now owes you the $6,000. At December 31, the end of the year, you would need to recognize that since 1 month had gone by, the bank has earned 1 month of interest. So that would be interest receivable and interest revenue. Remember that with simple interest notes, nothing is repaid until the maturity date. So on March 1st, when the note matures, the bank is going to be collecting all the principal and all the interest. So 3 months of interest would be an additional $135. On the maturity date, the bank would remove the note receivable and remove the December's interest receivable. And also, the bank has now earned interest for 2 more months, January and February, which is $90 more of revenues. The grand total would be a debit to cash. What we've accomplished here with the last 2 journal entries is getting a good cutoff. What year did that revenue really get earned in? So 1 month of revenue was earned in the old year. 2 months of revenue is earned in the new year. All right, now in Chapter 10, let's see how closely related these entries really are. Instead of the bank loaning out the money and have a receivable on their books, if you were the person that showed up at the bank to borrow the money, you are walking out the door with cash, and you owe the bank $6,000. After 1 month has gone by, 1 month of interest has accrued, and from the borrower's perspective, that's an extra month of interest that they're going to have to pay later. So we have an interest expense representing the cost of borrowing that money for that 1 month period, and an interest payable due to be paid off later. When the note matures in March, the borrower is going to be removing the big note payable from their books and the 1 month of interest payable. But they're not just repaying the principal in 1 month, they need to pay 3 months of interest. So the additional 2 months or $90 becomes interest expense related to January and February of the new year. The grand total cash out the door is the $6,000 of principal plus all 3 months of interest. So take a look at this practice problem. You might print off the blank one that I have provided for you and see if you can do it on your own. It's a good way of reviewing and connecting together the entries related to notes from Chapter 8 and now what we're learning about notes payable in Chapter 10.